Gold is the topic of the day and investing in it. The first thing I need to sort of clarify is what is gold and what is investing in gold. Gold is a commodity like any other, but unlike other commodities which are consumed, gold is stored, and it's stored forever. And the reason it's stored is because it's a currency. It's not a usable commodity. The gold price and investing in it is very, very cyclical, and that gold price is related to the business cycle and the credit cycle, and gold currency becomes valuable when other currencies are not valuable. So gold is money, and that is the basic principle of this, and the reason gold is money and gold has value is because gold can't be printed. Other currencies get printed when governments go to war, when governments need money to spend on various things. They print money, it's what they do. When they print too much money, the value of that money goes down, and people tend to go to gold as an alternative because gold is the only currency in the history of currencies of the world that can't be printed. It can be mined, but it only can be mined at a very slow rate. Therefore, the market cannot be flooded with it. As an example of how much gold there is in the world, that's about it in physical terms. All of the gold that's ever been mined, or I would say 95% of the gold that's ever been mined, is sitting in vaults around necks. There's a tiny bit in people's teeth. But the reason gold is a currency is because it's all still available. Now, there's a lot of people that say that gold's an old currency. You know, they used it in Roman times. It's no longer relevant. And you're welcome to believe that if you choose to. But whenever you've believed in other currencies, they tended to crash eventually. No currency has ever survived more than about 100 years on average. And it doesn't really matter what we think, unfortunately, because the majority of the world is in Asia. And they 100%, no questions asked, believe gold is a currency because their currencies devalue even faster than ours do. And 2/3 of all of the gold in the world goes to Asia on an annual basis. They have 2/3 of the population of the world, and they continue to buy it at a much faster rate than we do. So while the marginal price of gold sets the price, so the 5% or so more or less that we own in the West can make prices rise or down, the baseline demand for gold is coming from Asia. Now, precious metals enter a bull market when real yields turn negative. And what that means is when inflation is higher than the amount of, when you put money in the bank and you make a yield on it, 1%, 2%, 3% if you're really lucky, if the money you can make in the bank is more than inflation, then you're making a real yield. But right now, the world is in a negative yield environment. So when you put your money in the bank and inflation's going at 2% or 3%, and your money's only making 0.5%, you're losing 1.5% of the value of your money all the time. And that is essentially why people buy gold and why the price of gold rises. Now, the quantitative theory of money is not a theory. They call it a theory, but it's not. Basically, it's an equation. So when you print money, and that money turns around in the market as a money multiplier, what you get is a higher gold price. Now, people have said, we've printed so much money over the last 8 years, and the gold price has not risen. The reason for that is because the gold price, for the money multiplier to work, the number of transactions have to keep going up and up and up. And the gold transactions in the world have not gone up, unfortunately, because we've been in a low growth environment. Growth has finally started ticking up, as we've all noticed, because both inflation and the official GDP figures have started to rise. And that means that with growth and the quantity of money that's been printed, we might be in line for the greatest gold bull run in history. Now, precious metals are inversely correlated to the stock market. And that means when the FTSE, when the S&P is doing really, really well, gold tends to do badly. Now, you're all looking at me and saying, but the stock market's doing brilliantly. Yeah, the stock market is doing brilliantly. The stock market is trading at some of the highest multiples it's ever traded at in history. And when stock market multiples get to where they're trading right now, in terms of price to earnings and everything else, they tend to crash. They correct. That's what they do. And people who are expecting that correction, which is 80% of the professional investors in the world at this point in time, that's when you know that things are going to turn in gold's favor, and that's why gold over the last year has started to rise. So gold is actually getting more rare and more expensive, and what that means is all of the easy pickings are gone. We used to find gold with a little piece of rock with a shiny piece sticking out of the top, and the average grade of gold was, about 10 years ago, was about 2 grams per ton. Right now, the average grade of gold in the world is 0.9 of a gram per ton. There's just a lot less of it, and it's getting much, much harder to find and much, much deeper. And that means it's more expensive to get out. And ultimately, if it's more expensive to get out, the price of it's going to go up. So the question is, we discussed earlier that mining and gold are cyclical commodities. So where are we in the mining cycle? I'm not sure we're exactly at 8 o'clock. I think we might be closer to 7:30. But this is generally where we're at. So at the peak, when mines are at their actual highest valuations and gold's at its highest level, usually that means, much like the stock market, it's going to correct. It goes up, it goes down. The cycles in the mining market last anywhere between 3 years and 5 years. And the quote I put earlier was actually Jim Mellon's quote. You want to rent, not own mining stocks. And the reason why you want to rent and not own mining stocks is because they're cyclical. When they're going up, you want to be buying them. And when they're about to turn, that's when you want to sell them. You don't own them forever. You don't stick them in the back of your portfolio, despite what many of these guys will tell you, and wait. During the 5-year bull market, you want to be buying them. During the 5-year bear market, which will come in the next 3 to 5 years, I suggest you sell them. So where is gold in this bull market cycle? Those are the last 7 bull markets that we know of in the world. The little black line is where gold is in this bull market cycle. So in the next 3 to 4 years, gold will correct again. I would say for the next 2 to 3 years, you probably should be safe investing. But according to that, we have at least until gold hits 2,000, because usually gold in any bull cycle at the very least doubles. And given that this gold cycle bottomed at 1050 gold, you probably have about 2,000 gold to go. Now, to be very, very clear, gold does not go up, no market, no stock goes up in a straight line. It will go up in a wiggly line, like one of those. It'll go up and down, and it takes 3 to 5 years to go up. So gold is not going to hit 2,000 in December of this year. Gold will probably hit 2,000 in the next 3 to 5 years. So why would you own gold stocks instead of actual gold? Because gold stocks will outperform gold. If gold goes up 1, on average, in every gold history, gold stocks go up 3 times more. So for every 1% gain in gold, you should get a 3% gold in the average gold stock. HUI, the index, is the index of large gold producers in the world. So where are gold producers in this bull market that we've just started in approximately January of 2016? They're about there. Now that would suggest that they're at about 200% to where they'd been, and that they can probably double again and double again before the end of this bull market cycle. Now the question is, would you buy big gold producers or do you buy junior gold producers? If junior gold goes up 3 times, if regular large cap gold stocks go up 3 times, small cap gold stocks should go up 6 times. It's just a rule of thumb, but it's happened in every cycle consistently over and over again. That being said, the inherent amount of risk in a junior gold stock is at least double, if not triple, that of a producing gold stock. So how do you watch the gold market? You watch all of those things. So you watch gold, and then you stock pick the junior companies. Now, stock picking is an art, if anything else. If you want to buy gold and do well with it, in the first year of the cycle, you can almost buy any gold stock and it's going to double or trickle. If you want to buy gold in the latter part of the market, then you need to stock pick. You simply can't buy any gold stock. You have to be much more picky if you want the gold stocks to do well. I run the Peterhouse Smaller Companies Gold Fund. If you want any of this information, including this presentation, you can find it on our website. And if you have any questions, I'm going to go hang out at the Ariana Gold booth, which is, I think, number 61, and I will answer any questions there. Thank you very much.